at remittances, trade, and investment, fostering connectivity and sustainable growth, looking at how we can use remittances and shift the investment narratives on the continent. Our moderator for this panel is Mr. Innocent Isichei. He is the director, ACIOE Associates.
Good morning, everyone. I was really happy to have listened to the other panel because some of the conversations they talked about actually dovetails into the very important issue of remittance flows within Africa. Today, I'm delighted that we have an esteemed group of panelists who are going to provide greater perspective on these issues, from being practitioners, from supporting regulation, and also developing products that can enable more remittance flows within Africa. So the first on my list is Ridwan Olalere. He's the CEO of Lemfi. Lemfi is a remittance company that is supporting cross-border payments to key markets across Africa, including Nigeria, Kenya, Ghana, and it's also supporting flows to India and China as well. So Ridwan, I would like you to come on stage. The next on my list, we have Riyaadh Hanslo. He's the vice president at GTXN. GTXN is a payments company that supports B2B payments, cross-border flows for SMEs across the region. I would like to also invite Mariama Jalloh-Heyward, who is the program director for Alliance for Innovative Regulation. And last but certainly not the least, we have Moses Mutabaruka, who is the managing director of the African Perspectives magazine. For many of us, remittance payments are a critical part of shaping lives and livelihoods in the region. In 2022, according to the World Bank report, close to $53 billion came in as remittance flows into Africa. And remittance flows are a major source of external financing for many countries. When you look at total FDI and total portfolio investment in the region, remittance flows actually exceed these flows according to reports that we've seen from the World Bank. And unlike when countries face crisis, for example, today we're seeing macroeconomic crises in parts of the region, in Ghana, part of Nigeria, and in Kenya. And you see significant forms of capital outflow. Remittance flows tend to be counter-cyclical in that you don't see outflows when others are moving out. So it's actually a significant source of counterbalance and helps to support balance of payments-related issues in the region. And when you look at the contribution to the growth and development of countries within Africa, they're actually significant. So in some countries, they constitute close to 20% of their GDP. In countries like Nigeria, I think they constitute close to 6% of the GDP, and in Ghana as well. But there are issues related to remittance transactions, which I think this audience, I believe, is going to address today. One of the first major issues is the issue of transaction cost. In Africa, despite the fact that most of the people who are beneficiaries actually need these funds, close to 8%, transaction costs are estimated to close to 8% of remittance flows in the region, which one could estimate to be roughly about $4 billion. These are actually significant amounts that could actually have huge impacts on lives and livelihoods in the region. So it's one issue that I hope that we'll be able to address today in this panel. How can we work to reduce transaction costs across the region? The second issue, which I think the other panel actually talked about, is really around settlement times. There's been a major issue when you engage with small and medium-sized businesses that engage in cross-border transactions. They often talk about the delays that are often incurred in settling transactions across the region. And when you look at migration within the region, within Africa, two-thirds of migration out of Africa, out of countries, home countries, the people actually reside within Africa. So there's a significant amount of cross-border payments within Africa that I think we often don't actually think about. We often focus about flows that come from Europe and from the Americas, but there's actually a significant amount of cross-border flows I think that we hope to address today because the costs are actually significant. When you look at flows from the US and transaction costs from the US and Europe, it's roughly about 8%, but within Africa, I think it rises almost 20%. So it's something I think that we should be able to address today in this panel. I'm going to move on to members of the esteemed panel today, and I hope that we'll be able to answer questions on how we can actually make remittances safer, faster, cheaper, and open to innovation that will support the greater growth and development of the region. So I'll start off by asking my friend, Ridwan, to actually leverage on his experience in telling us how we can address some of these critical issues around transaction cost and settlement time, which often constitute a key hindrance in terms of enabling greater remittance flows within the continent.
Thank you so much. Good morning, everyone. In terms of transaction cost, I think there are about 3 key factors. One being fraud. I mean, you have to think about transaction cost as net gross margin on take rate after all expenses, right? And so when you think about it from building that model, you'd see that businesses that play in the remittance space, if they want to be profitable, they have to pass on those costs to the customers, right? The higher the fraud in a particular corridor pair, so let's say UK, Nigeria, or UK, Uganda, the higher the cost contribution from fraud. Let me make it easier. If I was going to charge you $2 to send money back to Nigeria when you give me $100, if 5% of the time we see fraudulent transactions where we incur chargebacks, we're going to add that 5% to the cost. Now we're going to charge you $7 because 5% of $100 is $5. So we're going to charge you $7 for the fraud that is not from you, right? The fraud is not from you, it's from someone else. It's from other bad actors, right? But think about it, because the way chargebacks work in North America and Europe is that the merchants, right, which is the remittance player, incurs the cost, not the bank, not the person that was careless with your card, not the person that was careless with your open banking login details, not the person who willingly gave their open banking or card details to someone over the internet. They don't bear the cost, right? They get their money returned to them by the bank. The merchants, which is the remittance player, bonds that cost. And for them to become profitable, if they're only charging 2%, where 5% is already more than 2% of their own transaction fees, they have to pass it on to you. So that's number one factor that contributes to cost when you think about remittances to high-risk regions. The second thing is finding banking partners that want to work with you as a player for high-risk regions. So if I go to North America today and I walk into a bank and I say, we provide remittances for Africans living in this country. These are compliance processes. These are compliance programs. It's super comprehensive. This is our onboarding flow. Because from a PR perspective, Africa is seen as high risk, right? And the return on that risk is not big for them, right? They're going to say no 90% of the time. So they don't want to bank you. So if they don't want to bank you in the first place, then there's no settlement account for you to receive money into from your customers. And if you don't have settlement account, then what are you doing? You don't even have a business in the first place, right? So there are only a few banks willing to work with people who play in the African context, and they charge a lot for that risk. So just to open a bank account with them, they can charge you upfront payment of $100,000 and above, right? And then they give you a minimum yearly thing with or without your transaction process reaching that threshold. They don't really care, right? But I mean, you take it. You will take it because you've spent about 6 to 8 months looking for a bank, knocking on doors and getting no's for answers from these banking partners. So banking partnership is another significant reason for that cost. A third one is how liquid the market is, right? And if I think about how liquid the market is or how friendly the regulatory framework is towards open market approach, then you start to see issues around, so you've brought in the dollars to the country. Now you want to sell that dollar. How do you sell it? On a weekend, are there enough people to even buy it on a weekend? Right? All of these add on to costs to the customers because then it means that you're going to give them a bad FX rate just because that market wasn't liquid enough on that Friday. So Saturday, Sunday, up until maybe 10 a.m. on a Monday, the customers sending remittances back home for hospital bills, for school fees, for different things are going to incur that cost, right? So this compounds for Africa. And then this adds up to about, on average now, the World Bank said it's 8% plus. So if you're sending $100 as a diaspora, you're going to lose about 8% of your money. But if you're sending it from the UK to, say, Poland, the cost is about 0.5%. So it's about 15 times. So these three key things are the reasons why remittances from the West to Africa is still super expensive, right? But when we think about African countries to African countries, it's mostly liquidity issues, right? The currency pairs are not liquid enough from a market perspective that it first of all has to go through dollar, then back to. So it's like Naira goes through dollar back to Ghana cedis. Ghana cedis goes to dollar back to Naira. Even with the commercial banks in the country. So I feel like if we figure out a way to solve these key issues, then the cost would drastically come down.
Thank you, Ridwan. I'm going to move over to you, Riyaadh. I think because Ridwan talked about some of the factors driving or making it high, why you have high transaction costs. But as I mentioned earlier, 8% is in terms of flows to Africa. Right? Within Africa, it can get as high as 20%. And your job is helping to support small businesses across the continent by providing them access to FX liquidity to support cross-border transactions. So I'd love to also hear your perspective on what you think could be done to actually reduce the cost and also improve settlement times. And also if you could add a little bit of what regulators could actually do to also help to address this challenge.
Sure. So I think, Ridwan touched on some very important points. And I think, a lot of them, the underlying factors lie in a lot of the regulatory approaches that we've taken or we've seen taken across the African continent. I think the first, being heavily reliant on legacy systems, specifically with respect to settlement, that has a knock-on effect on settlement times. What that then does is for small businesses that are heavily reliant on, the amount of time that it takes for money to hit their bank account for them to be able to meet their cash flow needs, it's not sustainable. And so the deeper, I suppose, you go into small to medium enterprises, the more heavily dependent they are on the settlement time, settlement infrastructure that's in place. And what I think is failing small businesses is that sort of settlement infrastructure. So I think that there's a lot of work that necessarily needs to happen on that front. I think also underpinning that, and also with respect to prevailing interest rates, are things like currency controls and exchange control regulations that are currently in place in Africa. I think, this is not something that we typically see across Europe, one, but two, even within Africa, I think play an important role in underpinning, the financial stability of each financial ecosystem. That being said, though, I think that there is room for flexibility in terms of what our approach is within the African continent, in terms of how we treat certain corridors specifically within Africa, and there are definitely enhancements, efficiencies that can happen there that potentially, make settlement times a lot faster, allow currency conversions to happen a lot quicker, that potentially benefit small businesses heavily.
How do you think we can address that? I think if you could add.
Yep. So I think there's first the acknowledgement that there is liquidity in the market, and I think also to touch on what Ridwan has said is that sometimes a lot of the liquidity sits within traditional players within each of the value chains and the within particular ecosystem. Traditionally, those tend to be banks, and a lot of the time there is a valid reason why that is historically been the case, in order to support financial stability and other Reserve Bank objectives. I don't think that those are invalid in any way, shape, or form. In fact, I think they're really important. But I think over time and as financial technology has evolved, so has the need to recognize other players within the ecosystem has been equally as important to maintain financial stability, as well as ensure that the financial needs of the previously financially excluded continue to be met. We're now in a new era where traditional financial systems may no longer be fulfilling all of the needs of business banking customers or household remittances. How has that changed? How do we recognize those players within the market? And how do we regulate them in a way that still maintains financial stability, but also ensures that they're still able to, in a way, match both sides of that particular transaction. So, for example, with GTXN, we do see both importers and exporters, and so we see the need and liquidity of US dollars, for example, as well as the need for local currency. We are able to see that parity exists within the ecosystem, but aren't necessarily able to directly match them for a number of reasons. Either because regulation doesn't allow for that to exist in its current form, which means that there needs to be regulatory reform, or that there are a number of different licensing approaches that need to be taken, which then lead to a lot of regulatory arbitrage. What that then means is that regulation becomes fragmented across Africa, and it's even harder to be able to do business.
Thank you. I'll move over to Mariama. You work with the Alliance for Innovative Regulation, and there's been a lot of talk. I think I was looking at flows, for example, within Asia, and there have been questions around what the regulatory framework that's allowed for new innovative products within India, where people are able to not just solving for the immediate needs of beneficiaries, but also providing them with other options like savings, ability to invest in the equities market, invest in the debt market, and also leveraging new forms of technology like blockchain or maybe blockchain CBDCs and AI. So I'd love to hear your perspective on how these new regulations, this change in regulatory framework could actually help to advance, improve the efficiency of remittance payments in the region and address some of the constraints which Riyaadh and Ridwan have actually talked about. Thanks.
Thank you. Good morning, everyone. So one thing we know is that too much regulation can stifle innovation. We've heard that throughout yesterday and today. I work very closely with the global regulators, and one of the main things that we notice and we see, and what my organization, the Alliance for Innovative Regulation, our mission is to work with the regulators to get them comfortable with emerging technology like DLT, blockchain, generative AI. What you'll find is that, unfortunately, they are afraid of new technology, and they are doing business as usual. And in a space where technology is constantly changing, if you do not adapt quickly, you will find yourself left behind. We need to quickly close that gap within the continent in order to take hold of our power, our economical power that we know exists. I'll just give one quick story. I have been on almost a 3-week tour. In the past 3 weeks, I have been in Ghana, Nigeria, and now Rwanda. My experience utilizing digital payment has been vastly different among the 3 countries. Ghana was easy, it was seamless. I used my American credit card, my debit card, was able to move money out of the ATM, no problem. Nigeria, it was interesting because I sat at the table with CBN and with regulators and with MTN, and if you do not have a Nigerian-issued bank card or a Nigerian-issued credit card, those payment failures that we were talking about earlier exist. So imagine I'm unable to contribute to the economical, even providing funds into the economy because I'm very limited. I'm unable to move money. I'm unable to use my card, and so I'm shackled. Situation in Rwanda, completely different. I was able to move money, been able to use my card, no issues. So there needs to be some sort of harmonization. We've talked about it. I've heard a lot about PAPs. PAPs on the surface, and this is a controversial piece that I said, and since we were going to talk about. PAPs on the surface is amazing. However, the interoperability, again, is not there. The use cases are value chain. Being able to send money from one country, from Ghana to Nigeria, he mentioned it earlier, you literally, and a lot of people don't know this, have to send, you're either going to go through a US dollar exchange or through the UK exchange. Most people don't know this. So it's really important that we, one, get our regulators on board and get a good understanding of this technology, because blockchain can be used to mitigate fraud. It can reduce those transaction fees that you mentioned that payment providers have to charge in order to cover their bases. It can also, artificial intelligence can be used, again, we have to get in front of the bad actors who are utilizing deep fakes. It could be used as well to combat that. So we just have to get the regulators on board to get them comfortable with this new technology. Banks, the CBN, I think recently reversed guidance where they had actually banned crypto. Now, I'm glad that they actually have gone in and reversed that. However, it took some time for them to get comfortable again with it. So it's a level of working with the regulators to get them comfortable with the new technology as it exists.
Thank you, Mariama. I'll move on to Moses. How can the media play a critical role in shaping the narrative around remittance payments so we can actually work to address some of these issues that have been mentioned by the other panelists?
Good morning, everyone. Good morning. So I think as a storyteller, media maker, who've also spent quite a lot of time in the diaspora, I relate to that issue. I think, like many other areas on the continent, the banking system, the remittances have always, we work in silos. Maybe you set up a branch in the US, in Canada, and you can actually buy mortgage. You can actually build and invest in proper standing structures. I think we are seeing progress in that, in the sense that the banking sector is engaging with the media. For example, KCB Equity Many other banks have now opened up branches and offices in the diaspora, but still there's that lack of communication, there's that lack of storytelling. The banking sector or the people involved in remittance haven't done a good job of getting closer to the people who actually send the remittances. A perfect example of a country that's done that well would be like Rwanda. I think in the 80s, early 90s, the remittances to Rwanda was about $4 million, $5 million. Today is about 140. And in the last 10, 15, 20 years, the government of Rwanda has actually dedicated a day called Rwanda Day, where they put together everybody on a, I almost said on a bus, on a plane. They go to the US, do a whole day where they invite all the Rwandans there. They come, they see the opportunities, they see what's available to invest. They see different channels. They bring Bank of Kigali, they bring the equity banks. And so there's that cohesion of people and institutions and transaction. I think that will definitely help in fixing the gaps that we see.
Thank you. I'm going to go back to you, Ridwan, and I think maybe Mariama can chip in. Now, the question I have is, some of the rules around this, did they actually look at the peculiar nature of transaction activities within the region? And why I brought that up, because he mentioned the fact that when they were looking at transactions on M-Pesa, they noticed there was an upsurge in transactions between 5 to 7 a.m. in the morning. So the natural reaction would have been to, block those accounts. And they later on discovered that it was actually women, market women, who were basically trying to send money out before they began their daily chores. And so what's your perspective? I would love to hear from you. What do you think that some of these rules actually, because clearly very tight regulations could actually constrain innovation, and it actually makes it more costly, particularly for the beneficiaries in the region who actually need these funds. So I'd love to hear your perspective on that.
Thank you. Before I answer that question, I want to make a comment on your difficulty paying in Nigeria, which is, that problem ties to two things, right? It's quite funny. One is fraud, right? The acquiring rails to debit international cards exist in Nigeria. In fact, that's existed for like 10 years, right? The problem is that acquiring banks don't want to give merchant locations. My brothers here understand that POS and enable international MasterCard or international Visa cards. Because once they do, the manager of that restaurant or hotel will connive with some bad actors and bring so many foreign cards and start swiping. Remember, the merchant suffers, not the bank, not the owner of that debit card or credit card. So what happens is that chargeback flows in from the network to the banks. The banks just owe the money of the institution. So everyone is saying, you know what, I'm going to stay away from it. So that kind of created this behavior of staying away from it for the last 7 years. It's there, just disabled. The second thing is interchange fees in the West is quite high. I mean, in the UK and Europe it's much reduced, but international cross-border interchange fees are quite high, running up to 3%. Nigerians are already used to paying 10 naira per transaction. So a merchant getting debit, when you pay maybe $100 hotel bill, a merchant doesn't want to pay $3 to $4 to the bank for processing that $100. So they again disable it, So I'm so sorry for that.
I'm happy that you gave me that background, because I really was looking to the regulators to say, okay, this is an issue that they created, but I'm glad that you gave me that information. So CBN is off the hook.
Yeah, it's the off the hook. Regarding that, I think sometime, so let me paint a scenario of something that happened to us in Canada. So we launched our business first in Canada, allowing Nigerians and Ghanaians to send money back home to Africa. And we had a bank, and the bank, the first time they approved us, I was so excited because we spent 6 months looking for a banking partner. And when they did, they gave us this document saying, these are their do's and don'ts. These are the countries they want us to interact with. These are the countries they don't want us to interact with. You know that? To my surprise, Nigeria was fine. Guess which country wasn't fine? Ghana. And I was confused. I was like, what? Nigeria is fine, but Ghana isn't. I would have thought it should be the other way around. But what you find out is that compliance managers move from bank to bank, and they just copy. Because if I'm chief compliance officer or MLRO at this financial institution, when I move to a new one, I don't want to rewrite 300-page document. I just copy whatever we had there and just paste in this new bank, and I say, good to go. And what you find out for them is that, anyways, many of those institutions only interact with European countries. So the European countries are fine on that list, right, from commerce perspective. Many of these institutions don't interact with Africa, so they never go back to check if that country has implemented certain new guidelines and should be off the list. Ghana already implemented the new guideline more than 4 years before we met this bank. And they were not off the list for that simple reason. Which is because the person just copied and pasted, right? And then, for us, it didn't matter at that point because we're still a very small business. We weren't even doing a lot of transactions to Ghana, so we didn't really care. But when the time came, we went to check, and we found out that Ghana had implemented the new set of FATF rules. So we went back to the compliance officer and said, at that time also, I would want you to know we were making a decent amount, they were making a lot of money from us. So they were ready to listen. So we went back to them and said, Ghana, can you give us documents as to why you removed Ghana from this list? So they gave us the documents. So we came back to them and provided documents on behalf of Ghana to say, look, they've checked all these boxes. We think they shouldn't be on that list. And they got removed from that list. And what I'm pointing at here is that don't let anyone tell us there's so much fraud in Africa. America is the biggest market for fraud. It's not Nigeria, it's not Ghana, it's not Kenya. No. I'm telling you, online digital payment fraud in America will make you go bonkers, right? In fact, it's as if they've connived together with the banks. So there's a regulation which says that consumer protection allows you to report a transaction within 60 days. Sometimes it's 90 days, right? On your debit card or credit card. Remember, anything that happens on your credit card, as long as you can show that you did not initiate that transaction, gets returned because the credit card money belongs to the bank that is underwriting it, not really you, right? And so since you didn't spend it, you're not on the hook for it, right? For debit card, it's quite similar, especially if the merchant MID code is a money transmission MID code. Because according to Visa, MasterCard network regulation, certain MID codes cannot dispute, or they call it merchant categorization, cannot dispute transactions no matter what evidence you provide. So even if the card owner came to your platform, spent the money, went back to their bank and said, I didn't spend it, it doesn't matter what the merchant provides. The customer still gets their money back, right? Now, the banks charge a fee for all chargebacks. So which means they also have a revenue line for chargebacks, right? And sometimes some banks really make a lot of money on chargebacks. They charge as low as $20 per chargeback claim. So you can see this thing now. The banks make money. They don't bear any cost. The customer gets their money back if it's a debit card. The bank gets their money back if it's a credit card. The merchant suffers. At least in Nigeria, this is not really the case. If you can provide some evidence, you can file your dispute can get resolved, right? So when you think about fraud that happens in the United States on credit or debit cards, in comparison to what happens in Nigeria or Ghana or Kenya, it's like 5 to 10 or 5 to 20. So let's not, I think it's that the regulators in Africa haven't done a great enough job to kind of tell the world the different things or the different steps they've taken to combat fraud locally. And also the different international regulations they've also adhered to. They haven't done a great job doing that. And because of that, AML officers get away with copy-pasting from financial institutions to financial institutions. And that's just what we're suffering from.
Thank you.
So I want to piggyback off of what you said in regards to the consumer protection piece. That's the major cornerstone within the U.S. Financial system. So the way the U.S. generally handles fraud, if you can, there's most of the time, and I'll say most of the time, the merchant is not going to suffer in a space where fraudulent activity has taken place if they've already done their due diligence. The banks do take on most of the brunt in some situations. And so what you find is that the banks are really doing their best to fund anti-fraud, consumer protection type education. And so you'll see that they are at the forefront of that. In other jurisdictions or other regions, it's not so clear. As you mentioned, Nigeria, the merchant will take the brunt of it if fraudulent activity takes place. They're out goods, they're out services, they're out funds. We did a workshop at RegTech Africa last week where CBN, MTN, consumer protection groups were all at the table, and this is the first time that we were able to convene them and have conversations around how to tackle fraud. And one of the things that they was very, very clear. Nigeria is at the forefront of making sure that they can identify and mitigate and prevent. What became very clear is that even when they have identified these bad actors, these Yahoo boys, they're very easy, they're unable to prosecute. They don't have the necessary funds to stem that type of behavior. So you have two different models. You have the US getting in front of it and funding consumer education and making sure that the necessary tools are in the market to kind of slow it down. And then you have on another end where they are at the forefront and they're making sure that, you know, they can identify and see these bad actors, but they're not prosecuting. So you're not stopping the behavior.
So the okay, you don't
I know this is a very exciting conversation, and I know we could probably spend an extra hour, but thank you all for your contributions. And I would like to open it up to the audience because I'm sure they will also have questions, and I want to give them time to also pose their questions to the panelists. So please raise your hand if you have a question.
It should be working. Okay, it is working. So I had two, but let me focus with the one big one. I want to go back to PUBs. And, you know, we've had a lot of conversation around PUBs, even in the last year's summit. I think there's only 11. Maybe we managed to get one more country on board.
12.
Maybe
12 countries on it now.
Confirm whether we actually have up to 11 countries signed up onto PUBs right now. But in my mind, I'm thinking about how money is currently moving and whether perhaps already the technology has already been overtaken. The solution that PUBs was supposed to be solving, given how long it's taken, has already been overtaken by where the consumers are going, how quickly money needs to move. We still have a huge population of unbanked, and the KYC process will still be required on the PUBs. Then on top of that, you know, this idea of the switch, sometimes I think we speak as if a switch doesn't exist. We've been transacting for years. There's a switch, it's just in the wrong place. And so, the technology exists, everything exists. And to your point, perhaps, the air conditioning solution is a better business. Set up shop somewhere with air conditioning and there are no issues because it's not as if it's not happening. People are transacting. Money is moving. Business is going on. And I think that's my biggest maybe challenge to this thing. Is there already alternatives? We're seeking an alternative that perhaps has some level of control and maybe perhaps less security. But those alternatives exist. But I think we're behaving as if there are none.
I want to add on to what you said. When you go to Asia, for example, you notice, for example, between Singapore, India, Thailand, and Malaysia, their payment systems actually talk to each other. They have that interoperability, which allows you to move money from Singapore to India easily. And I think all these actually really help to reduce the cost. And you also that need for double currency conversion. So you could build on what she said. What are your thoughts on PAPS? And do you think there are other better models that could be leveraged on to foster greater cross-border payments in the region?
I'll start. I think that the problem is sort of a multi-tiered approach, right? So the first is a regulatory problem. So there are imbalances within regulations within each of the markets that potentially need to adhere to payments regulation. So you have the challenge of attempting to harmonize payments regulations across each market, which are vastly different, and then also have the added complexity of exchange control regulations that don't also exist in all markets across Africa, 1. 2, payment systems in themselves in each market are so fragmented to the point where, if you take South Africa, for example, that relies on banking platform to change something where all of the banks rely on one system to be able to take a KYC'd customer and change Y for yes, this person is KYC to a no is a 2-year project in order for a bank to do that, in order for another bank within the same jurisdiction to rely on that information. And then I think, throw in, the emergence of other technologies like stable coins, like CBDCs, that allow for faster settlement cycles, or even platforms that allow for settlement to happen on the particular platform in fiat currency. I think that already we have perhaps surpassed the need for systems like this, and potentially also made it easier to sign up to.
To add to that, yes, technology exists. It's not even a technology problem, right? The guy that has an office with AC, the only thing he doesn't have is a license, but he's already doing it, right? So it's about the liquidity of that currency pair. If you take the naira on behalf of Cameroonian currency, do you find somebody else to take the Cameroonian currency quickly from your hand before you make a loss? So the more trade that happens between the two countries that are trying to pair together, the easier it is to bypass the dollar.
But I think the important point there is that the transparency between that trade doesn't exist, I would say, sufficiently enough in order for regulators to make an informed decision on how to make better regulation. And so, it's up to platforms that have that data available to make it accessible to regulators in order for them to advocate for better regulation. I don't think it's fair to put it on regulators to advance regulation. I think that there's a lot to be said for self-regulation and regulatory advocacy. And ownership that platforms need to take on in order to make this successful.
I'll just add that it should work. we have to now do some due diligence to figure out why the trade between those 12 countries aren't, to your point, is there a platform that facilitates this other than PAPS, other than the rails? But the reading what they have put in place, it should work. I'm Sierra Leonean, and to your point, Sierra Leone, Guinea, Liberia, that it doesn't exist. And those are our neighboring countries. So there's a lot of work that needs to be done.
Thank you very much. Thank you very much to our panelists, and thank you very much to the audience for participating in this conversation. We touched on a great number of issues, really looking at around harmonization of regulations and how that could help to address some of these bottlenecks. And greater advocacy, I think, is also important in shaping the narrative on some of these major issues. We look forward to the regulators, so for example, the Central Bank of Nigeria, leveraging on some of the conversations in this topic. And thank you very much once again.